when we come back, we turn our attention to Nigeria and, of course, some other developing countries that have received an alarm bell from the World Bank. Stay with us. The World Bank has sounded the alarm over surging debts in developing countries, including Nigeria, warning it is driving away foreign private capital and threatening economic stability. In a blog titled "The Looming Global Debt Disaster," the bank revealed global debt is now 25% higher than at the start of COVID-19, pushing low-income nations into a doom loop of borrowing and weak growth. With government slashing investments in education and infrastructure to repay debt, the bank has urged urgent reforms and fiscal consolidation to avoid prolonged financial stagnation. Joining me for all this, I have Dr. Josh Bamfo, partner and global transfer pricing practice co-leader, Anderson in Nigeria. Thank you so much for joining me today.
Thanks for having me.
All right, so I think the big word for me, or the big deal for me in that report is the phrase that talks about looming global debt disaster. I'd like you to speak to us about how soon this might crystallize, because when we say something is looming, that means it's coming, it's going to happen or something. How soon might this crystallize, and what does it mean for the global economy?
I think this has been something in the making or worsened post-COVID period. We all saw global economies struggle during that period when it came to financing their expenditures. What happened was that most economies ground to a halt, meaning that with the limited economic activities, tax revenues, fell short of their budget. Meanwhile, they needed to spend so much in terms of, health expenses in order to keep their citizens safe. So huge budget deficits were run during the COVID period and post-COVID period. We also saw the adverse impact of supply chain disruptions due to the Russia-Ukraine war, leading to high inflation rates across the globe. So by and large, these huge deficits have added to existing debt stock, leading to in some countries, leading to areas of debt unsustainability. So as much as possible, when you even look at it from the advanced economies, US has a debt stock of about 36 trillion USD. We've seen the Trump government pass its beautiful bill, which is going to potentially add another $2 trillion within a few years' time. So even for the advanced economies, there are concerns in terms of debt sustainability. Now, if you look at the developing economies such as Sub-Saharan Africa, this is even more severe. We've seen a number of countries go through a debt restructuring process or policy in recent times. Ghana went through one with IMF. They are now actually getting out of it. We saw Ethiopia enter into some arrangement with IMF, same with Zambia. So by and large, there's this general concern as to the sustainability of the debt stock of a number of economies. Some have actually reached a debt distress level, and some have actually gone into a crisis level. And I think what the World Bank is trying to do is sound a warning to those who've not yet gotten into a debt distress position so that they can start implementing policies that can avert that. But I believe that globally, this is a major concern. Fiscal consolidation has become a major policy prescription from the multinational financial institutions such as IMF to most economies. And so hopefully we might be able to avert this crisis. And that's the reason why I believe that the World Bank is sounding this warning, that if measures are not taken, then this will be inevitable. I want to believe that those measures will be taken.
It's interesting, and I like the fact that you're hopeful. But, talk to us. How many of those countries that we know of have actually started the fiscal consolidation we're talking about? Maybe we should start from home. Here in Nigeria, how well are we doing in that regard?
So when you look at it, if you look at the budget, all right, the budget had a target, and when you look at the deficit to GDP ratio of around 3.89. The recent IMF report that came out based on their review of the economy said that looking at how things are going, they could actually end up around 4.7% of debt to GDP ratio and deficit to GDP ratio if measures are not taken. So clearly, we really need to adhere to the recommendations of the IMF team, because the more we add to our deficit, the more we add to our debt stock. So if our deficit is too significant, that means we didn't have enough revenue to finance those expenditures, then all we need to do is borrow to finance those deficits. And the more we borrow, the more we add to our debt stock. The cost of financing becomes too expensive. You don't have the economy growing, revenue stalls, and you run more deficits, and before you realize, you end up in this loop of doom, right, where consistently you're in a financial crisis. So I want to believe that if we can take the right measures and the recommendations that the IMF gave, it's going to help us. And one of those measures was to ensure that we actually make sure that investments into capital projects are prioritized at the expense of recurrent expenditures. So if we need to make investment in terms of infrastructure, in terms of power, in terms of education, in terms of health, those are very important for economic growth. Those investments will let the economy grow, we then tax more, and then revenue goes up, and we can have a more balanced budget. But where we invest and we spend most of our revenues on recurrent expenditures, such as public sector salaries, or we spend 90% of our revenues on financing existing debt, then it comes at a huge cost to us, because we cannot make the right capital investment, and that can come at a huge cost. So these are lessons for Nigeria, to be very mindful about our debt situation and start managing our budget such that we have a reasonable set target in terms of deficit to GDP ratio. If we set it at 3.8%, let's do exactly that. We've seen that if you look at the budget, the estimates we had, or the targets we had for oil prices are falling short. We were expecting it to be at $75 per barrel. We are now hoping around $68 per barrel. In terms of production, we're hoping that we're going to get 2 million barrels per day. Now we are around 1.75. So once we don't meet those targets that we set, or those assumptions we made in our budget, then there's a high probability we might run a huge budget deficit, which can then add to our debt stock. So we need to be mindful and more prudent when it comes to expenditures, as well as the targets that we set for ourselves.
On the one hand, the government needs to sort of increase spending in critical sectors like education, security, healthcare, infrastructure. And then on the other hand, it needs to service ballooning debt. I mean, as of March 2025, we're talking over 140 trillion naira debt. And we're also looking at adding some 21 trillion naira and all of those. Now, what is the way out, and how soon can we expect to get out of this before it becomes a doom loop? Because these are two important things. We've got debts to service, and on the other hand, we've got infrastructure, health, education, security, and all these other things we need to tackle.
Yeah, so there's a little bit of creativity that has to come to play. Traditionally, government has had to fund fully almost all these major capital projects. Question is, can government actually partner with private sector investors to be able to fund some of these critical capital projects, as opposed to solely funding them? So that is one area that they need to think about. The other aspect has to do with, the type of expenditures that, we make. We need to be very prudent. Some of these expenditures, do they actually lead to economic growth? And if not, then we really need to cut out some of these, recurrent expenditures that actually do not lead to growth. So there are a number of things that we can actually do to manage that and strategically see whether we can actually fund these capital projects solely on our own, or do we partner with the private sector. But by and large, I believe that some of the recommendations made by the IMF should help. For example, the reason why the current government made away with the subsidies was the significant pressure it was putting on the budget, funding this year in and year out. Question is, how much savings are we making out of the removal of the fuel subsidy? And how transparent are we about the amount, and how it gives us fiscal space in order to invest in capital projects? So these are some of the things that I believe if the government can actually embark on. More transparency in terms of the savings from the subsidy removal, making sure that we cut down on, not unnecessary, but cut down some of the recurrent expenditures and push them to capital projects. Be mindful of our borrowings. Already we are too excited about issuing Eurobonds and being oversubscribed. But if you look at the interest rate being charged on the 10-year Eurobond of 10.375, that is one of the highest you can see even within our sub-region. Benin got a similar loan, 14-year loan, for around 7.9%. Cote d'Ivoire had a 12-year loan for around 8.75%. So clearly, we need to be mindful of the way we go about borrowing, given the fact that if we get into this situation of excess borrowing, our debt servicing alone is going to take almost all our revenues. Recent times, our debt servicing cost as a ratio to our revenue has sometimes been north of 90%. That means almost all our revenue is used to finance our debt. That is not sustainable. So some of these measures have to be taken into consideration when we're considering borrowing, be it locally, domestically, or international, where you have to pay USD at a time that our currency is relatively weak against the dollar.
All right, thank you so much. There's a lot to talk about. I mean, I would have talked about the fact that at some point in Nigeria, we saw a wave of exits, but right about now, we'll see what looks like a recovery, whether you're looking at the stability in the foreign exchange market, you're looking at the thinning premium between the foreign exchange market, or you're also looking at private capital, where Nigeria had the leading, inflow of private capital in West Africa, and all of those. Those are bright spots. I just wanted to comment briefly on this. Is it something we should be excited about, or it's just a tentative or a brief, shoot?
I think these are good news. I mean, given where we are coming from, where inflation ended last year around 34.8%, all right, now we have inflation a little below 23%, I think 22.97%. We have our exchange rate having been pretty stable in recent times, hovering between 1,500 and 1,600. All these are giving international investors some confidence in our economy once again. And that is the reason why we are seeing significant inflow in terms of capital back into the US and into Nigeria, which is a very large economy in the first place. So the good news is that we are seeing recovery. We are seeing new increased interest in investment in Nigeria, and we need to be excited about it. But at the same time, I like the way World Bank is cautioning us. Don't get too excited because you are not out of the woods yet. You still have some looming challenges. Inflation is still highly elevated. 22.9% is just too high. Exchange rate at 1,500 is still significant.
All right, Dr. Bamfo, I'm afraid we need to go now. Thank you so much, Dr. Josh Bamfo, partner, Global Transfer Pricing Practice Co-Leader, Anderson, Nigeria. Thank you for your time and your thoughts. And of course, many thanks for watching. I am Perpetua Fasami Peter. Enjoy the rest of the day. Bye for now.